Hello everyone, this is Gracie here. So in this video we will be discussing about International Financial Reporting Standard 13 Fair Value Measurements. IFRS 13 was originally issued in May 2011 and it's applied to annual periods beginning on or after 1st January 2013. So what is the main objective of IFRS 13 is it is established to define what is fair value, and it sets out in a single IFRS a framework for measuring fair value, and it also requires disclosures about fair value measurement. So these are its three objectives where it defines what is fair value and it sets out a measure platform for measuring fair value, and it also requires for disclosures about fair value measurement. So this IFRS 13 fair value measurement will not be applicable to all kinds of transactions. It is only applicable to certain instruments or certain shares or instruments. So let us get into the definition of IFRS 13 here. So IFRS 13 defines fair value as the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at measurement date. In brackets, it states at exit price. So what does this definition defines here is fair value is nothing but the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at a measurement date. So it is a measurement value for a particular asset or liability to be sold or to be paid. The price which is fixed at a rate based on the market conditions and based on the market participants is known as fair value. So what it defines in short is it defines as the price that would be received to sell an asset. It is a price which is set to sell an asset and receive the payment and receive the amount, and or paid to transfer a liability or to transfer a liability, the measurement of fair value, how much liability to be transferred in an orderly transaction. This in the transaction when required between market participants at the measurement date. So what is exit price here is the price that would be received to sell an asset or paid to transfer a liability. Yes, the price, exit price, entry price is before it is a time where you purchase an asset, that is the transaction for purchasing the asset. So exit price is where that purchased asset you're going to sell it. When you sell it, what is the exact price you're fixing to sell that asset and receive amount from that vendor, from that particular dealer. The asset which is sold to that particular dealer, at what price are you selling that asset and what is the amount you're going to receive, that value what you decided to sell that asset is known as fair value. So it is also called as exit price, where your asset is going out. So when your asset is moving out and you're receiving money for it, that price is stated as exit price. Fair value is the price which you fix to sell that asset. So here this standard gives an information about fair value and exit price. So fair value is nothing but is equal to your exit price. So in order to increase consistency of fair value measurement, IFRS sets fair value hierarchy which classifies inputs used in valuation techniques into three levels. So how are you going to measure your fair value? So what are IFRS has set up a hierarchy for fair value measurement. Here it is divided, or valuation techniques is into three levels. So they have given three levels here. So level 1, level 2 and level 3. So level 1 inputs, level 2 inputs and level 3 inputs. What does it state is, so according to level 1, the inputs or the types are: level 1 assets are those valued according to readily observable market prices. These assets can be marked to market and include like marketable securities, foreign currencies, treasury bills. So what is this definition stated here is, quoted level according to level 1, quoted prices in active markets for identical assets or liabilities that an asset can access at a measurement date. So these are the various levels how a fair value can be decided. So it is not easy to decide fair value. There are three levels where what are the what are the what are the disadvantages and advantages are you going to face, or what are the challenges you're going to face to set up or to measure a fair value? The first one is quoted price and active market for identical asset or liabilities that an equity can access at a measurement date. So under this quoted price, the best example for this first level is your equity shares or the shares which is traded in a listed exchange, listed shares wherein a public trading. So when it is quoted price, there is no much risk involved in deciding a fair value, where the price for it is already decided based on the market conditions. So there is no need for you to further decide or identify what is your fair value. The price for it is quoted, where shares traded in listed stock exchanges or any bonds or any kind of instrument which is already traded in listed stock exchange, the price for it is already quoted. Level 2, other than quoted market prices included within level 1 that are observable for the asset or liabilities, either directly or indirectly, that is quoted prices of similar assets. So what this level 2 hierarchy states that these assets and liabilities do not have regular market pricing but can be given a fair value based on quoted prices in inactive markets or models that have observable inputs. Example for this level 2 markets are interest rates, default rates, yield curves. So what this level explains is the the identification of fair value for this level 2 will be little riskier than level 1. Level 1 is a quoted price where the price or the fair value can be measured or decided quicker, because the value is already studied based on the market conditions and it is followed periodically. But when it comes to level 2, it is a slight riskier in the measurement of fair value. Example for this is why is it riskier is everything is based on the market condition. Example for this can be interest rates. Interest rates will not always remain same. It keeps on fluctuating based on the market conditions. So to decide the fair value of an asset or liability based on these conditions or these circumstances is difficult. So level 2 lies in such category or such fair value hierarchy. So when it comes to level 3, unobservable inputs or assets or liabilities, IFRS 13 then outlines a fair value measurement approach by stating what an entity shall determine when assessing fair value. Further guidance on measurement is given, including characteristics of asset or liability being measured, the highest and best use of non-financial assets, market transaction, and many more. So this is a least marked to market level, where the measurement of fair value is very riskier and very tough to identify, whereas in level 1 and level 2 it can be identified easily. But when it comes to level 3, it is the toughest level or toughest asset and liability categories where the identification or measurement of fair value is difficult. So it is a category where the asset value is based on unobservable inputs. So it is based on unobservable inputs. Assumption from market participants are used when pricing the asset or liability, given there is no readily available market information on them. So what is this disadvantages? Assumptions from market participants are used when pricing such assets and liabilities. So here only assumptions are being considered as inputs. Along with assumptions, readily available market information is not provided because this kind of securities keeps on fluctuating, or the assets and liabilities involved in these kind of markets keeps on fluctuating. So level 3 assets are not actively traded. So their major disadvantages, they are not actively traded and their values can only be estimated using a combination of complex market prices. So examples of level 3 assets include mortgage backed securities, private equity shares, and foreign stocks. So what is mortgage backed securities? It is also known as MBS, which is mortgage backed securities, are bonds secured by home and other real estate loans. They are created when a number of these loans, usually with similar characteristics, are pooled together. For instance, a bank offering home mortgages might round up to 10 million worth of such mortgages. So when you issue a loan, can be considered as a liability. So when the repayment when a loan is issued, usually a home loan, a security is being pulled out or a security is being collected for the loan which is being issued. When such loan is issued and a security is being collected for it, it is not, a bank doesn't engage in issuing a single loan. Various kinds of loans will be issued based on mortgage or home loans. So when such loans are issued, if it is an active participant, that is, if there is any non-performing asset, then it is fine. When there is any non-performing assets identified in such loans, then it is difficult to find out what is the fair value for such activities or such subjectivities. So when it is mortgage backed securities, when any loan is issued based on the asset, based on the securities, then the deciding of fair value for such asset and for such particular loan is difficult, where only estimation is possible and assumption is possible, but the real fair value based on the market condition is difficult to identify. Then the other example is private equity shares. So as a private equity shares, the share value or the price will vary based on the yield curves of that particular organization or entity. So it also fluctuates. So the level 3 hierarchy is little tough to estimate, or the fair value is little tough when it is private equity shares. So next, with reference to valuation, IFRS 13 discusses three valuation techniques. Market approach, it utilizes the information from market transaction. Cost approach, it involves current replacement cost. Income approach, based on future cash flows, income or expenses discounted to present value. Then IFRS 13 sets broad range of disclosures. So before getting into this, let us discuss with reference to valuation. Market approach uses prices and other relevant information generated by market transactions involving identical or comparable assets liabilities or group of assets and liabilities. So it utilizes the information from market transactions. So there are three kinds of valuation techniques based on the market price, cost approach, income based approach. So market approaches, it utilizes the information about from market information. So where the trading activities is actually carried on based on that relevant information, the assets and liabilities prices will be set up based on the market conditions or at the place of business. Example, a business section, or based on the demand and supply, based on the market participants and market condition, the prices will be decided. So when it comes to cost approach, it reflects the amount that would be required currently to replace the service capacity of an asset is. So cost approach here is where it reflects the amount that would be required currently to replace the service capacity of an asset. So it is currently to replace any service capacity of an asset, then this cost approach will be utilized. Where your need or requirement is immediate, then cost approach can be used as a valuation technique. Next, the third one is income approach, which converts future amounts like cash flows, income or expenses, amounts reflecting current market expectations about those future amounts. So where your income approach based on future cash flows. So according to this, the fair value technique can be or valued based on the future cash inflows based on in the present itself. So where converts future amounts or cash flows or income and expenses to a single current amount. So to a single current amount based on the discounted to present value. As you have already calculated present value and how to find out present value, but which gives you the future estimation at your present value. So that is your income approach, where what is going to happen or what will be the future cash flow after 5 years can be estimated at the present using discounted present value method. So these are the three techniques which is used to evaluate your fair value. And then IFRS 13 sets broad range of disclosures related to fair value measurement, including identification of classes, specific disclosure for each class of assets and liabilities measured at fair value, and many more, both in descriptive and quantitative format. Yes. So, in detail, if you get into IFRS 13, it clearly explains where you need to utilize or where you need to adopt IFRS 13. What kind of assets need the requirement for measurement of fair value. Not all assets and liabilities require measurement of fair value. Like employee benefits doesn't require fair value measurements. Then retirement benefit plans of employees doesn't require fair value measurements. So every asset in the organization or every liabilities, any assets or liabilities, any receipts or payments what you make require fair value. But IFRS 13 tells you which kind of assets and liabilities require fair value measurement when you get into a detailed study of it. Thank you everyone.